Welcome to The Foundry, where leaders are forged daily. Each week we investigate themes of leadership, entrepreneurship, and mindset with some of the greatest minds in real estate. And now, the data scientist of real estate, George Roberts.
Welcome back, entrepreneurs. At the Foundry, we believe that investing in alternative assets does not begin or end with real estate. That's why I'm blessed today to have the pleasure of interviewing Denis Shapiro, founder of 𝐿 Capital Group. Denis began investing in real estate in 2012 when the market was just beginning to recover from the global financial crisis. He built a cash flowing portfolio, including many different alternative assets, including note and ATM funds, mobile home parks, life insurance policies, tech startups, industrial property, short-term rentals, affordable housing communities, and more. He co-founded an investment club for accredited investors in 2019, and following the success of his investor club, he launched 𝐿 Capital Group. 𝐿 Capital Group's mission is to bring clarity and accountability to alternative investments for passive investors. Denis also wrote the Alternative Investment Almanac, Expert Insights on Building Personal Wealth in Non-Traditional Ways in 2021. His book is based on his own experience becoming a successful alternative asset investor and also on interviews with some of the best alternative asset investors in business today. So at this point, I'd like to welcome to the show, Denis Shapiro. Welcome, Denis. How are you doing?
I'm doing great. Thank you so much for having me on today.
All right. Well, just like to start with your wide array of assets. I also invest very widely, also writing about alternative investments, and just wanted to start by asking, how it all came about that you invested in those various asset classes. We just take a couple like the note and ATM funds, mobile home parks, life insurance policies.
Yeah, I'll rewind a little bit. So when I first started investing in alternative investments, the first investment I made was a low-income housing property, and I had to manage it myself. And it became, I knew I didn't want to scale that, right? I didn't want to scale having one property and having to do everything myself, being the contractor, being the handyman, being the, chasing for rents type of situation. At that time, I was working for the government, so I had a pretty stable W-2, and I knew that I did want to invest in some of these asset classes. I just didn't really know how. So after my first foray with owning real estate, I started researching more passive ways of doing it, and that's kind of where I stumbled in. The first passive investment I made when I just became an accredited investor was a note fund that got me into that, and then I think the gateway drug for me in the alternative space was multifamily. Once I found out that you could syndicate a really large apartment building, that negated a lot of the cons I saw with single family rentals, and that kind of opened up a whole door, a whole pathway for me. And it was a really slow process. This was from 2012. It was a probably 12-year process of incremental steps, from discovering that these passive investments exist to actually starting to network with other investors. And then I guess the answer to your question is, how did I get involved into these other different spaces? It was really just the network that I started building out. You would get on a phone call with an investor because you want to share a story. And then even if the point of the phone call was to talk about multifamily, most likely they also have invested in a self-storage deal or a mobile home park deal. And that's kind of was the start of the idea of my future book, was to kind of try to map out a conversation that you might have with another investor, where you might start off with, hey, how's your deal in Houston going? And then by the end of the hour conversation, you're talking about a startup that you just invested in. So that was kind of the epitome of my book, was to kind of create that conversation. And that's kind of, hopefully that kind of answers your question.
All right, cool. Well, great. And good that you were backing up a little bit there, because usually the question I like to lead with is when you're at a cocktail party and someone asks you, what do you do? How do you answer?
So I just say I'm a real estate entrepreneur, and I try to really focus on the locality of it because we do invest heavily locally. So, I try to explain to them that, hey, I'm a real estate entrepreneur. I get together a couple of investors and we usually buy local properties around us. And I'll give them examples of some of the properties that we're buying. That's usually kind of how I try to segue that conversation. And from depending on how they respond, I'll quickly drop it or I'll quickly we'll have a conversation about it.
Yeah, well, I love it. And I love the way that you define yourself as a relationship-driven investor. I feel like I have a very similar story. Got into alternative assets and really just started asking the question, why does everybody seem to stop at the first square that they find? Like, for example, I often describe multifamily as the gateway drug, just as you do. And so many people, they'll get to that first square and they'll say, hey, this is good. I'm just going to stop and do this. And it seems sad because just by investing in your first alternative investment, I mean, you've already gone so far behind or beyond, I should say, beyond stocks and bonds. Yeah, if you continue to nurture those relationships, you'll find the world is just so much wider than that. Anyway, your experiences.
I think you're right, especially the more now that we're approaching our 12th year in the space, if there was one variable that we try to pinpoint of like which investments have been our most successful, it has always been the ones we've had the best relationships with. And that's why you can't limit yourself to one specific investment, one specific asset class. We have a couple of really great people in our network. One of them owns 80% of the mobile home park market in his specific geographic area. Whether or not, my intention is to invest in the mobile home park or not, if he's bringing me a deal, that's a high priority deal for me. And it has nothing to do with the asset class, it has to do with my relationship with that specific operator. So I think it's important. At the same time, I think it's important not to chase shiny objects, but at the same time, I think it's important to really focus on the relationships of investing versus just returns, risk rewards. And that's where people always stop. They're like, oh, I invested in that deal. And you're like, well, why? And the number one reason they'll say is, oh, it had a 20% projected return. And you're like, yeah, let's see how that shakes out when you have 100% capital loss. So I think it's about understanding that what really drives the market, besides the marketers out there really stressing out the how passive this investment is the actual it's the ability to create real relationships that can directly impact your bottom line.
Yeah, huge relationships. That's how we get into deals. That's how we operate them. Very, very important. Well, next, I'd like to talk about how you built up your wealth. I know that you've used infinite banking. So if you could just briefly tell us what is that and how has that helped you in your journey?
Sure. So infinite banking is basically life insurance policies that are usually underwritten by mutual companies. And I'm not a life insurance agent. This is not me trying to push the product out for any sales aspect of it. It's a life insurance policy where a majority of your contributions goes towards the cash value of the policy, which you will have almost immediate access to. So for example, I created a $10,000 a year policy. By year 5, I have access to $50,000. When I don't use it, it's earning me 5-6%. And when I do have investments that provide me double-digit returns, like a hard money loan or something like that, I could pull out of that, put in the hard money loan, use the proceeds to pay back the interest from the life insurance policy and kind of grow my assets that way. I think the best way you look at a infinite banking or high equity cash value or be your own bank, they're kind of all interchangeable. Is that fact is you're gonna make that end investment anyway. It's about creating a middle asset in between. So, if you're gonna go and buy 10 mobile home parks, doesn't it make sense to go and start a middleman, which you have full control over, that can grow over time? And you're basically putting money in the middleman, then borrowing from the middleman to buy your mobile home parks. The end result is you're owning your mobile home parks the whole time. However, if they're good assets and they're paying back those loans, you would have created a whole nother asset that you would have never created if you just invested directly into the mobile home park.
Right. So you end up with 90% or access to 90% of the cash value while at the same time, you're able to see that cash value grow. I mean, it's still in the policy, even though you're borrowing, it's still as if it's actually there. It's growing. So yeah, good stuff. Well, then, here's another thing I think most people haven't heard of: life settlements. This is really interesting because a lot of people, they might have a life insurance policy, maybe something that isn't working out for them anymore. Maybe they hear about infinite banking and they want to go and maybe sell it. You can get more than the cash value of the policy, and then maybe move into something more appropriate. I mean, that is to say, not every insurance policy is appropriate for infinite banking.
Sure. So life insurance settlements is a little bit, even though it's related to life insurance policies, it's almost the complete opposite of infinite banking. Like infinite banking, the focus is the cash value, right? With life insurance settlements, you're actually buying a portfolio of mature, usually term life insurances. If they have any cash value in those policies, that cash value is usually used to convert it and pay down some of the loans. What ends up happening is it's a collection, let's say, of 100 policies. The average age, usually there's a set defined average age in that policy group. So what happens is after the age of, I think it's 91, the life expectancy of a person is 6 years, give or take, regardless of their health standard at that point. So what they'll do is there's companies out there that they'll syndicate, basically buying a portfolio a certain age group. So let's say it would be 85 and older, or 88 or 91 and older, whatever it is. And they know in 6 years, give or take, a large chunk of that portfolio would have passed away. So they know what their future returns are going to be. They just don't know if those returns are coming in day one or at the end of the 6 years, but they have statistics behind them to make those kind of decisions. Usually
Right.
you're in the realm of 13 to I think 12 to 15% annualized returns when you factor in the back end of it. It's a very different investment than some of the real estate. Usually with real estate, you do get an element of cash flow, unless it's a development deal. So you usually get, a chunk of the rent as profits or whatever it is. But with life insurance policies, usually these life insurance settlement funds, they'll spend the first 3 to 4 years really buying down existing policies and making sure that they have enough money to make the monthly payments for these policies. And then what they'll do is once it reaches a certain tipping point, they'll start distributing. So it's very much like a zero cash return year 0 through 4. And then from 4 to 7, you start getting lump sum payments as the policies in there mature.
Right, fair enough. And so I got kind of interested more from the retail angle of like getting rid of, but the real money, as you mentioned, is in owning the policies. So many important companies, let's just throw one out there. Berkshire does this, right? They'll
Yeah.
they'll actually go out. So tell us, why does Warren Buffett like this so much?
It's you're basically investing in people in the one thing that's, was it two things that are guaranteed in life? What's the quote? Taxes and death.
Yeah. Benjamin Franklin, Death and Taxes.
The death and taxes, right? So you got one of them right there. So it's uncorrelated. It's uncorrelated, and I think a lot. What's attractive to these high net worth individuals, and Berkshire, I believe Bill Gates, when I was researching my book, had a huge chunk of assets in there. Also, I think the insurance companies themselves have large chunks of these life settlements on their books. I think what's super attractive is the financial ratings behind some of these insurance companies. And they're a lot safer than a regular American bank. So it's kind of a way for them to store money in a very, very secure financial institution that can only lend out a very small percentage of their funds versus a bank where there's fractional banking involved. So it's a lot safer place to store their money. And the returns are comparable to a lot of the other returns you'll see in other alternative assets.
And a bit of a hedge too, then, because when a lot of these insurance policies paying out is exactly when they would have their greatest liabilities.
Yeah, any natural disaster or anything like that actually increases your benefits.
Yeah, or age structure of the population, et cetera. Okay, cool. Well, anyway, why don't we move on to something a little more familiar to our audience: apartment syndications. As you mentioned, gateway drugs. Tell us What got you interested in apartment syndications? What are the pros and cons?
So I always really wanted to get into real estate. I did work for the government, which was very non-real estate related. So I always had this pull of doing something for myself. I knew smaller single family stuff wasn't the answer. So I was listening to podcasts one day, and there was a syndicator out there, and he was like, yeah, you could buy 1% of an apartment building. And that just seemed super attractive. And my mind was like blown. I was like, this can't be for real. And I started researching local syndicators. I really wanted, if I was going to, spend $50,000 with someone, I really wanted to go and sit down and have lunch with them just so I could have a conversation with them. The one thing working for the government, I probably have interviewed 10,000 people in my career. So I had a pretty good sense of, if I'm sitting with someone and talking to them, I usually have a pretty decent bullshit sensor from working for the government for so long. And I met a local syndicator. He had a deal coming up and I wanted to give it a try. I did. And then a few years, I think I was following it for a few months. And then I had two individuals who we started talking about these syndications and they kind of wanted to do it with me. And that's where we kind of created the investment club from there. And from there, we did 10 to 12. And then we started seeing the data start coming back, which deals were successful, which deals weren't successful. And that kind of changed everything because now we were playing with a different set of rules. Like we understood what rules actually mattered, what was actually fancy marketing and not really actually important at all to a deal. And that's when we started really taking another serious step into this whole space.
Yeah, huge because I came from IT and we just love to take an iterative approach. I think investing is another place where being iterative makes a huge difference. You get to work with people for a little while. You get to see how the deals are going and hopefully have some exits. And when you do, yeah, a totally new perspective. Good way to put it. So then you do talk about a lot of other types of assets in your book, like mortgage notes, mobile home parks. Why don't we just pick one of those? We'll start with mortgage notes. Why don't you tell us what do you see as the main advantages and disadvantages of investing in mortgage notes?
So mortgage notes, that would be a good. So one thing I want to rewind is it's important to understand that each asset class has a very specific pros and cons. I think where people make mistakes is they try to fit an asset class into every single type of investment bucket that they need, right? So they try to make a cash flowing deal into a great equity appreciation deal or a development deal into a cash flowing deal. And you come to this realization that each asset class has its unique skill sets. And that's kind of why I transitioned from traditional to alternative. It was because I couldn't find a way to get great cash flow from my stock portfolio. So when it comes to mortgage notes, it's actually kind of ironical. I know we talked about apartment buildings, but right before that we were talking about these cash settlements, life insurance settlements. And for 4 years you could go without any cash flow at all. Mortgage notes are almost the complete opposite, where you are getting heavy cash flow from the start if the deal is structured right. Now, there are some situations where you're buying non-performing loans where those are mortgages that have defaulted, and there will be a time period where you have to get that mortgage to either reperform or you would sell that mortgage note. But in theory, if you're buying a performing note, that means you've now become the bank in that situation, and then you get all the cash flow that's associated with that bank. So mortgage notes are a pretty interesting asset class. I actually really, now that I'm getting a little bit, we're actually transitioning out of some of the creative cash flow investments like ATM funds, and there's some other ones out there, and we're actually going much more heavier into mortgage notes because we have collateral position. That means if there's something that goes wrong, we have an asset to actually take back. And because of the collateral, we're willing to take a couple less percentage points and just eliminate a lot of unknown variability into our portfolio.
Yeah, huge. Being able to foreclose, not a nice thing, but a lot nicer than 100% loss. So, okay, yeah, let's talk about some others. I mean, these are all interesting. Some known better than others to this audience. Mobile home parks. I think that was one of the first things that you started to invest in.
Yeah, that was just the opportunity that we ended up having. So when we started that investment club where we were doing a lot of limited partnership investments, and just quick summary, limited partners, there's really no management decision, nothing. You're wiring the money and then you sit back and watch. We got to the point where I wanted to take the next step, and I felt that the next step would be a joint venture. And that's a hybrid between a limited partner and general partner, where you get to work with people putting the deal together. You get to see behind the scenes, but you don't have to be necessarily the lead operator. So we had a joint venture presented to us early on, right after we kind of started the investment club, and we signed up for it. And it was a mobile home park in Topeka, Kansas. It didn't do very well, but it was great to get on a week. It was I think every 3 weeks we were getting on a call. We were going through management issues at the park, whatever the situation was, where we are with the business plan, the whole 9 yards. So mobile home park was one of our first real opportunities to take a step away from limited partnerships and start moving onto the operational side. Mobile home parks now are one of the hottest commercial assets there are. Before, when I was researching for my book, 10 to 20 years ago, no one wanted these things. And it was really easy to get. It was a much higher cap rate than regular commercial real estate. These days, it's on par with anything else. So if you're buying a nice mobile home park, you're basically paying the same cap rate as if you were buying a Class B apartment building. So there's huge demand. There's a lot of courses out there. There's a lot of PR stigma. You actually have to do like PR management when you are buying these mobile home parks, because you will be vilified quickly. So a lot of times as an investor, you're looking at a business plan like, wow, you could raise the rents $200 to $300. Yes, but what happens if 10 of the tenants start complaining to their congressman and you start getting that type of attention? How can you still execute that business plan? So I think the mobile home park, especially when you're talking about with people's rents that are $400 to $600 a month, they're way more price sensitive on a $50 increase, $100 increase. So there's an element of social, I think, ethics that is a little bit different than multifamily or anything. But in theory, the simplest form of mobile home parks is, you're buying the raw piece of land and then you're charging your tenants for utility hookups. There are other parks that implement what they call park-owned homes, where they're renting out the actual home. It's a higher rent, but the operational costs are usually higher. Most mobile home park operators that I talk to on a consistent basis, they do not like that model at all, and they've switched over. Or if they buy a new park, they try to get lease to own option right away for the tenants. But it's a low operational cost. There's not a lot of mobile home parks. I think during my research for my book, it was something like there's only less than 10 new mobile home parks that come online every year across the country.
Competition is definitely diminished by the stigma.
The stigma. No one wants it in their backyard.
Yeah.
Everybody realizes, affordable housing is a huge need, but everybody does.
It's something that everybody talks about, but nobody seems to like the solution.
Yeah, exactly. So again, and there's so many stigmas. Like the operators that I know, they operate really nice parks, and they even have some doctors in there that retired. They traveled the whole world, and they just need a point of contact when they come in, and they'll take a thing so they could be close to their family. But then they're going out and they're renting a villa in Italy. But the point is, they're not spending a lot of money, and it's a great affordable place if it's the right park. So mobile home parks it's a really interesting asset class. We like it, but that's mainly because of the relationships we've built in that space.
Yeah, and then you mentioned the park-owned homes not being very popular with the owners. Would you say that's mainly due to financing concerns?
No, just operational expenses. Now you become a landlord, a more traditional landlord. Now you're potentially fixing toilets, and you have to deal with, something like the roof leaking, all of those type of things you don't deal with if you just own the land. And all of those issues now are contained within the tenant's ledger, not yours.
Yeah. All right, good. ATM funds. Now, this is exciting because you get some massive cash flow up front. Problem is that you don't get that equity back at the end. I mean, if you're not saving your money, reinvesting some of it. Wow, ATM funds can be, potentially a negative. So, what do you see as the main pros and cons of ATMs?
Yeah, we'll start off with saying like our company SIH, we invested in the ATM fund through our income fund, but we've started phasing out that investment. We originally really liked it, just like I said, it has high cash flow, but the business model is very, very unique because what happens is you're investing into a depreciating asset. ATMs after 7 years technologically are no longer valid because technology changes pretty rapidly in that space. So it's almost like a worthless asset after 7 years. So what they do is the way they structure your investment usually is that you get your money back by year 4. 4 to 7 is really your profit. But at the end of the day, you're walking away with zero and all your
Yeah.
profit would have came in a monthly. So a lot of people don't really, it's a tough transition to really understand it. The other big thing is usually an investor is not a user of an ATM. So it's kind of hard to put why would someone pay $3, $4 for fees? But at the end of the day, there are funds out there that allow you to participate in the fund's returns, and they'll own thousands of ATM machines, and you would get a contractual rate for 7 years of at a minimum of how well these ATMs will produce, and then anything above that goes to the operator, and then you're left with zero at the end. So it's a unique business model. We've shifted away. We kind of apples to apples. We like mortgage notes and hard money way more than ATM these days, but it is an asset class. It's been a viable asset class for decades, and some people actually just buy ATM machines directly. There's a little bit more operational oversight at that point, but it is a viable asset class. In the last since COVID, the money in circulation has increased significantly, and that's the number one factor dictating the overall success of an ATM industry is if there's cash in circulation or not.
Right. So, one thing that I'd like to underscore, you mentioned that the people who invest in the funds are not really the people who are paying as the end users, right? You have the unbanked, the underbanked. These sorts of people are actually, ending up with higher fees, etc. Is that the case? Is that your analysis? Or
Yeah, exactly. So there is a huge population. I think I was shocked, and during the research of the book, it was something like 19% of the US population is unbanked. And it's a shocking number because I've had a bank account since I was like 8. So
yeah,
I couldn't understand that. But for credit not being documented in the United States, there is a plethora of reasons, and these ATM machines become basically the only financial access to these unbanked populations. So they don't mind paying $3. To them, it's normal and it's not an issue at all.
yeah, yeah. Very true. Very true. Well, look, you launched your equity company as a result, or I should say, following on the success of your investment club. So, tell us about that. What did you get out of starting an investment club, and what are some of the advantages of doing that?
So to answer the investment club question, the investment club allowed me to 10x the amount of data that I received. If I was doing it myself, I would have probably done 4 or 5 deals at that time period. I was able to get 20 deals, and then you learn certain things from those deals that I probably would have never had access to if I didn't have this investment club. So it also allowed me to go to deals like for that joint venture, and it wasn't just me putting in the bare minimum. Now I had a few people that I could bring in with me. So it definitely provided me certain access and resources that I wouldn't have had if I was doing everything solo. Now, you have to be careful. There are different investment clubs out there. Ours was really simple. It was just 2 other accredited investors, and we got together and we just created one LLC. You want to be careful because you may unintentionally create a security. If you do that, if 1 or 2 of the members become passive. But in theory, if you get a couple of people that are really engaged and they want to, make decisions together, investment club, I think, is a great way to go about. There are tax consequences, so just something to be aware of. It is you're filing partnership returns, or you turn around and you do an investment club in theory, but then you individually invest, and there's nothing wrong with that as well. So there's multiple ways of doing it, but the point is you want to surround yourself with people that you could talk through the deals, which is super important when you're starting out. and you want people that have different viewpoints than you. So in our fund, we had one guy who specialized in crypto and the other guy who specialized in startups, and I specialized in multifamily. And just getting their viewpoints was really, really important on a lot of decisions that we made. And I think, that collective approach works really, really well. And I think that started the whole SIH for me, because I started seeing the power of a partnership that works.
Yeah, it's huge. I know in your Brian Burke interview in your book, he mentions that all of his deals that didn't turn out marvelously, they were all deals that his wife didn't like. So having another, yeah, having business partner, a spouse, investment club partner, yeah, very, very valuable. Well, let's continue on the angle of networking. So you say that you were able to learn the language of real estate using LinkedIn. So how do you use LinkedIn effectively, and how do you really use it as a tool to make you a better investor?
So I think a lot of investors, they make a mistake when they get interested in a topic. They'll start going to like a meetup before they understand the basics of that topic. And I've been to some of these events, and they're kind of painful to be in sometimes. And when you're a new investor, you need to understand that educating yourself with your time is really the best investment you can make. So whether or not you're on LinkedIn or you're listening to podcasts, I think the trick is to start understanding the lexicon, the terms of commercial real estate before you start networking with other people. What ends up happening is, if you start networking with other people before understanding the basics, you're going to end up coming off as very, very needy, because you're like, well, what is a cap rate? What is a cash on cash? How do I
Yeah.
get this? And that is not a good conversation. That's not like a productive networking conversation. You want to go in there saying like, hey, I understand the cash on cash for mobile home parks is between blank and blank. I see that you're projecting 12. How are you getting that projection? Like, what are you going to do differently than what a standard deal looks like? That's a question, right? So when you go in there and you start with the basics, it's just going to make you look bad. So one of the tricks that I've used to build up my, verbiage that I kind of needed was, when I went into LinkedIn, I just changed the bottom to investor, and I put multifamily investor, whatever it is. What ends up happening is people start reaching out to you for calls. And a lot of times that those calls are kind of spammy, but what it allows you to do is it allows you to have a one-on-one conversation. Yes, they are trying to usually sell you something, but they're using the terms. And once you get off the phone call, then you jot down those actual terms, look them up. So on the next phone call, you already know 4 or 5 terms. And if you do that for a month or two, you'll understand the language. And then now you can go to the meetups. Now you could take the next step of creating real relationships, because you have the basics down at that point. Now you don't have to go on LinkedIn and go on calls. You could also do this on podcasts. You listen to a podcast like this. Hey, Dennis mentioned cash on cash, IRR. He mentioned mobile home parks. I'm just going to write these 5 things down and then go do the research. And then once you feel like you're listening to these podcasts or get on a phone call and you didn't need to look up any terms afterwards, you're ready to then take the next step.
Yeah, knowing what you have to offer is huge. Like, do you have capital? Are you going to be the boots on the ground, et cetera? Where do you have experience? Some people have experience in real estate before they become investors, maybe property management, et cetera. So, or construction. Yeah, totally. Huge, huge, huge. Well, how about this? I love the book, love this interview. All good things have to come to an end. How about this? Can we wrap up with my favorite set of 7 questions? I call it the 7. Ready?
Yeah, let's do it.
All right. Okay. You could be known for only one thing, Dennis, what would it be?
Relationship-driven investments.
What's the greatest lesson in leadership you've learned as an entrepreneur?
Bad things are going to happen. How you respond to them is what makes them good.
What personal characteristic has been most pivotal to your success?
Accountability.
All right. Okay. So time for a random question. Just let me know when to stop cutting.
You could stop.
All right. Top question. What do you dream your life will be like in 10 years?
Just complete time control.
Can you give us a tip or trick that investors can implement in their business today?
Try to improve 3 people that are directly above you and 3 people directly below you.
All right. Can you name a book that's helped to forge you as a leader and as an entrepreneur, and tell us why?
You could do Never Split the Difference. I think just reading that book like once a year is good practice.
All right, cool. And can you send us out with a quote to help forge our listeners as leaders and entrepreneurs?
Oh, a good quote. Doing the same thing over and over again and expecting different results, I think was the definition of insanity. So if you don't like something about your life, do something different.
All right, love it, love it. So then I want to make sure everybody is able to reach out to Dennis Shapiro. So what's the best way? Email, website, carrier pigeon, smoke signals. How do our listeners get in touch with you?
Yeah, best way is honestly �SIHcapitalgroup.com, capital with an A. Reach out, click learn more. My email address is Denis, DENIS at SIH Capital Group. I take care of all my investor relations. I don't have an investor relation person in front of me. So anytime you email that email, it'll go directly to me. And then you could access my book on Amazon, The Alternative Investment Almanac, Expert Insights on Building Personal Wealth in Non-Traditional Ways. And yeah, just reach out. Love to connect.
Beautiful. Well, thank you so much for taking the time to share your knowledge and experience with our audience. Can't wait to release this episode.
Thanks for having me.